Subscribe to my channel Report Stock.
Welcome back to the Deep Dive. Sometimes tackling a company's quarterly report feels like you're just drowning in numbers, right? Trying to figure out what really matters.
Absolutely. It's easy to get lost in the weeds.
Exactly. Ever wish you just had a guide to cut through it all? Well, that's what we're here for. Today, we're digging into NIO Inc.'s second quarter 2025 performance. They're the China-based EV maker everyone's watching. Our mission today is simple. Pull out the key insights from their latest financials, the expert takes, and give you the real story without the headache. Is NIO charging ahead or maybe hitting a speed bump? Let's find out.
And that's so important because those initial numbers, well, they often only give you part of the picture. Especially in EVs, things move so fast.
So true.
We really need to connect the dots here, look beyond just the headline figures and see what NIO's performance actually signals, for them and for the wider EV market.
Okay, let's unpack this then. NIO's Q2 2025, it had some numbers that definitely catch your eye, maybe not all for the best reasons initially.
Sure.
They reported a loss per American depository share. That's the ADS of 32 cents. Now, that was a little wider than the Zacks consensus estimate, which was looking for a 30-cent loss.
Okay, so a miss on the loss estimate.
Yeah, and revenues also came in a bit short. $2.65 billion reported versus the estimate of $2.76 billion. So a wider loss, a revenue miss. What's your first take? Red flag time.
Well, hold on. It's easy to jump to that conclusion, and the market often does react quickly to misses like that, but, you've got to look a bit deeper.
Okay.
What's really interesting here is that even with those misses, NIO's revenues actually climbed. They were up 10.6% compared to the same quarter last year.
Okay, so year-over-year growth is still there.
Exactly, and that growth, it wasn't just random. It was mainly driven by higher delivery volumes, getting more cars out. And for any car company, that's fundamental, right? That's the engine.
Right, deliveries are key.
So yeah, they missed the analysts' guesses on paper, but the underlying business, the actual operations, they're clearly expanding.
Okay, so the top line might have wobbled against expectations, but the factory floor is humming. Let's talk deliveries then, because like you said, that's where it gets interesting. NIO delivered 72,056 vehicles total in Q2. That's a pretty solid jump, 25.6% more than last year.
That's a strong number.
It is, but what's maybe even more telling is the breakdown. They got this multi-brand thing going on now.
Right, with Onvio and Firefly joining the main NIO brand.
Exactly. So 47,132 were NIO brand. Then you had 17,081 ONVO vehicles and 7,843 from the Firefly brand.
Wow. Okay, so significant volumes coming from the new brands already.
Yeah, they're definitely moving metal with this strategy. But does this multi-brand push, maybe into more affordable segments, become a double-edged sword?
That's the classic question, isn't it?
Are they risking, blurring the lines of their premium NIO image, or even stealing sales from their own higher-margin cars?
It's a balancing act, definitely. Expanding with Onvio and Firefly, it clearly boosts the total numbers, gets them into different parts of the market, maybe bigger pools of buyers. That's the play for market share.
Makes sense.
But yeah, the risk you mentioned, brand dilution, cannibalization, it's absolutely real. You have to manage that carefully, keep the main brand special while growing everything else.
Right.
What also jumped out at me, though, was that vehicle sales revenue, okay, that was up 4.2% to $2.25 billion linked to those deliveries. But their other sales and services, charging, maybe accessories, they skyrocketed, up 65% year over year, hit $401 million.
Wow, 65%. That's huge.
It really is. That's not just a small side business. It suggests people are really buying into the whole NIO ecosystem, not just the car. And that can be super powerful for loyalty and, recurring revenue down the line.
Yeah, that 65% number definitely tells a story. It's not just about selling the initial product anymore.
Okay, but let's pivot to the money side, profitability, because this is where it feels a bit mixed.
Nuanced is probably the word. Right. So gross profit, good news there. $264.9 million for the quarter, up 14% from the year before. Solid improvement.
Okay, positive step on gross profit.
But then vehicle margin, how much they make on each car itself, that actually fell. It went to 10.3% from 12.2% back in Q2 2024.
Interesting. Down almost 2 percentage points.
Yeah. And the source material we looked at said the decline was partly due to lower material cost per unit, which sounds like it should help margins, not hurt them.
Right. Usually lower costs mean better margins.
But it also blamed a general decline on changes in product mix. So how does that work? Gross profit up, vehicle margin down. even with lower material costs.
That's the puzzle, isn't it? And the fact that vehicle margins slipped despite lower material costs really points the finger strongly at that changes in product mix factor.
Ah, so back to the NVO and Firefly brands.
Exactly. It goes right back to that multi-brand strategy we were just talking about. If a bigger chunk of their sales are now coming from these potentially lower priced, maybe lower margin O or Firefly models compared to the premium NIO cars,
That would drag down the average vehicle margin. Makes sense.
it's a trade-off, right? You chase volume and market share, maybe accept a bit less profit on each of those specific units. But the fact that the overall gross margin improved it was 7.6%, up from 4.9% last year, that suggests they're finding efficiencies somewhere else.
Or maybe those other sales are just really profitable.
Could be that too. Or a combination. It really makes you think, doesn't it? How do you balance these different margin numbers? Is it about pricing power, cost control? Where's the real win coming from? Volume or efficiency?
That's a great question for anyone analyzing this. It's clearly not just one simple answer. Okay, so beyond sales and margins, what about spending? Operational costs? Because growth is great, but you got to manage the spending too.
Absolutely.
Key piece of the puzzle.
Research and development, R&D, came in at $419.8 million. Interestingly, that was actually down 4.2% year over year.
Down on R&D for a tech-heavy EV company?
Yeah. Feels a bit counterintuitive. Is that like a strategic pause?
Yeah.
Or maybe some big projects just wrapped up? Could be either, honestly. R&D spending isn't always a straight lineup.
Yeah.
You have cycles, right?
Okay.
Intense development phases, then maybe it eases off as things go to production.
Okay.
So it might just be a natural dip in their development pipeline, or maybe they're just being more focused with their R&D dollars right now. It's not automatically a bad sign.
Gotcha. But on the other side, selling general administrative costs SG&A, those were up 7.1% higher than last year, hitting $553.5 million.
Now that makes sense given the growth. As you scale up, launch new brands like Own NVO and Firefly, build out showrooms, service centers, SG&A is naturally going to climb.
Yeah, costs of expansion.
Exactly. It's the cost of building the brand and its physical footprint, especially somewhere huge like China.
And how about their financial cushion?
Yeah.
The balance sheet. As of the end of June 2025, NIO had cash and equivalents of $992.7 million. Long-term debt stood at $1.27 billion.
Okay, so roughly $1 billion in cash, a bit more in long-term debt. That gives you a snapshot of their immediate financial flexibility. Always critical for these growth companies burning cash to expand.
Right, so we've got this picture, growing deliveries, complex margins, shifting operational spend.
Oh.
What does this all mean looking ahead? Did our sources give any clues about Q3?
They did. They provided NIO's own projections for the third quarter, and they're pretty ambitious.
Oh, yeah. Lay it on us.
NIO is guiding for deliveries between 87,000 and 91,000 vehicles in Q3.
Whoa, okay. Compared to the 72,000 in Q2, that's a big step up.
It is. If they hit that range, it implies year-over-year growth of somewhere between like 41% and 37%. Huge jump.
Yeah, revenues.
They're projecting revenues between roughly $3.05 billion and $3.19 billion for Q3, so also anticipating a significant sequential increase.
Okay, ambitious targets.
Yeah.
Now, how does Wall Street view them currently? You mentioned the Zacks rank.
Yeah, currently NIO has a Zacks rank #3 that's categorized as a hold.
A hold, okay. But you also mentioned our sources highlighted some other auto sector companies with a strong buy.
That's right, and the contrast is quite telling.
What makes a company a hold versus a strong buy in this system?
Yeah.
And what can we learn from those other guys?
Good question. So the Zacks rank is heavily influenced by earnings estimate revisions. #3 hold basically means analysts expect the stock to perform roughly in line with the market average in the near term. #1 strong buy, on the other hand, signals high confidence from analysts, usually driven by positive estimate revisions, suggesting the stock might significantly outperform.
Yeah.
So while NIO's own Q3 forecasts are aggressive and suggest potential future upgrades, the current hold rank likely reflects that recent history of misses and maybe some ongoing caution about those margin pressures we discussed.
Makes sense. So who are these strong buy players?
The examples given were Modine Manufacturing, MOD, Gentex Corporation, GNTX, and Bluebird Corporation, BLBD. All currently Zacks rank #1.
Okay, so not necessarily direct EV competitors like Tesla or BYD.
Right. These represent a different kind of strength within the broader auto supplier and manufacturing space. They aren't maybe the super high growth disruptors like NIO aims to be. Instead, they're showing more consistent, stable performance.
How is
Well, take Modine. The consensus estimates point to double-digit sales and earnings growth for their fiscal 2026. And analysts have been raising their earnings per share estimates recently.
Okay, steady growth, positive revisions.
Exactly. Same story for Gentex and Bluebird. Gentex is looking at decent growth for 2025, estimates going up. Bluebird, focused on school buses, also shows solid projected growth and improving analyst outlooks. They offer this profile of, let's say, more predictable, solid financial performance.
Which is quite different from NIO's current story,
Yeah.
right? High growth, yes, but also higher investment due to current losses, more volatility.
Precisely. It highlights the different kinds of opportunities and risk profiles you find even within the same broad sector.
So wrapping this up then, we've seen NIO navigate a really complex Q2. There was that wider than expected loss, yes, but also really strong delivery growth, fueled by that multi-brand strategy.
And that big jump in other sales, can't forget that.
Right. Plus, those ambitious goals for Q3 suggesting they plan to keep the pedal down. And we've seen how NIO, with its hold rating, kind of contrasts with more established, consistently profitable players in the auto world getting those strong buy nods.
Mm-hmm.
Hopefully this whole deep dive has given you a clearer, maybe more layered understanding of where NIO is right now. It's definitely not just about one or two headline numbers.
Absolutely not. The story is always in the details and the trends. And maybe a final thought to leave you with.
Yeah.
What really stands out to you when you compare a company like NIO, laser-focused on growth, market share, building this whole ecosystem in a super competitive, high-spend EV space, with those other companies we mentioned, the Modines, the Gentexes, showing maybe slower but more consistent, profitable growth.
Interesting comparison.
And how do you weigh things? Like, how important are short-term misses on earnings or revenue compared to the long-term strategy? You know, building out these new brands like Onvio and Firefly, diversifying, especially in a market changing as fast as electric vehicles.
That's a great point to ponder. It really gets to the heart of investing in growth versus stability.
Exactly. Food for thought.
Definitely. Keep asking those questions. Keep digging deeper. That's all for this deep dive into NIO's Q2 2025. Thanks for joining us.
Subscribe to my channel Report Stock.